Just waiting for my technical stuff to be sorted. Thank you. Yeah. Hello. Good morning, and welcome to today's episode of Modesty's Mortgage Masterclass. Welcome to this week's dosage of your Mortgage Masterclass, which is where we dedicate this day's financial education to mortgages and protection. And in this session, I'm going to be talking about something very important as far as mortgage products are concerned. So today we're going to be talking about mortgage products and interest rate options. Now this is very, very important for you, whether you are looking to take on a new mortgage or you're remortgaging or you're a first-time buyer. It's important that you understand the different options available for you as far as choosing your interest rate options are concerned. Now, the interest rate options are basically giving you options as per interest rate applicable to your mortgages, because every mortgage product comes with interest, and how that interest is applied is exactly what we're going to be talking about. And then when you know the options available to you by assessment of your circumstances and your objectives in terms of what you're looking to achieve, then you can make an informed decision. That is what we hope to achieve. But before we dive into today's topic, I just want to bring you up to date with what is happening in the mortgage industry as per the COVID-19 situation. Because of the current situation, the market is changing almost on daily basis. There are updates coming up from lenders and from stakeholders in the mortgage industry, and we owe you a duty of updating you with knowledge on what is happening in the mortgage industry. So first of all, the credit reference agencies like Experian, Equifax, and TransUnion, they've all come together to say, look, the mortgage payment holidays that you have taken from your lender because of this coronavirus situation will not affect your credit scores. So what it means is that if you have taken a mortgage holiday from your lender, I did explain what this mortgage holiday means the last time I was here. I think it was last week. That your lender can ask you to defer the payment of your mortgage, which is a holiday. So it means they can suspend the payment of your mortgage for 3 months. The government has allowed them to do that so that for the next 3 months, whether you're a landlord or you're an owner occupier, you will not have to pay your mortgage for at least 3 months, and after, so that we can see where the market is after 3 months. And then after that, you will not work out between you and your lender how you are going to pay the arrears. It doesn't mean you're not going to pay it at all. It's just suspension of it. It's just a holiday. So normally, if you do not pay your mortgage, it affects your credit score. It's recorded as a default. But now the credit reference agencies who update these records and who update these records based on the information they get from the bureau, from the lenders, and from these institutions have come together to say, we are going to treat this 3 months holiday as a payment holiday. So we're not going to allow it to affect your credit score. So that is sorted with the credit reference agencies. The other thing that has come up again in the market this period is that lenders are withdrawing hundreds of products from the market simply because they are short of staff. It's not a reason for you to panic. There is no need for you to panic because lenders are withdrawing the products from the market. It's not because the market is collapsing. It's simply because they haven't got enough staff capacity to manage the existing products and the application of becoming through. So they want to focus more on managing the payment holiday situation and supporting their existing customers through this difficult period. So they cannot do that with the level of staffing that they've got, because they've got a lot of staff who are working from home and they've got a lot of staff who are not, currently in the office. So it's becoming difficult for them to manage that, all that application and new products that come with it. So they have had to withdraw hundreds of products from the market because of that. The other reason they've had to withdraw some of their products as well is because of the difficulty in valuation. A lot of the valuation that should be happening are face-to-face valuations. So if face-to-face valuation is required for them to approve any mortgage or any remortgage, they can't possibly carry it out under this present circumstance because valuers cannot go and carry out face-to-face valuations because of the current coronavirus situation. So they've had to withdraw a lot of those products on the market, especially products that are above a certain loan to value level. So if you are borrowing above a certain loan to value level of a property, it requires a face-to-face valuation. Now the lenders have an option of a desktop valuation where they value your property, without actually visiting the property. But that desktop valuation can only be done for products that are up to a certain loan to value products. Sorry. Now, because of that, they cannot continue to do valuation face to face, and they will only offer products that suits that desktop valuation situation where they can value your property without having to go and visit that property. They can offer you that product. So they've had to withdraw hundreds of products from the market because of these, obvious difficulties, and because obviously from the market we're operating and the environment we're operating in, it's become impossible for them to sustain those products even in this current market situation. So the focus is on the existing customers and for them to support them as much as possible throughout this difficult period. These lenders have said we are going to reintroduce these products or even launch new products in the nearest future. But for now, we cannot take new applications. So lenders have also stopped taking new applications on certain products as well, so that they can also focus on managing the existing clients. The other thing that has happened in the market this time around is that lenders have extended the mortgage offer that they have given to existing clients or clients whose application have reached the offer stage and they have made the mortgage offer to them. When the lender makes a mortgage offer to you, it has an expiry date. So within that period, if you do not take up that offer, if that mortgage does not complete, that offer expires. It means you have to make a fresh application if you still want to go ahead, and that fresh application is based on the product that are available in the market at that time. So what the lenders have done now is they are saying if your mortgage offer is expiring, we are going to extend it for another 3 months to enable you move home or to enable you complete the mortgage process in your own time, or to enable you complete the mortgage process. Now, people are finding it difficult to move homes because it's either the person who's supposed to be selling the house, maybe the person is showing symptoms of coronavirus, or you can't possibly move, or the logistics company can't possibly operate because of the situation we find ourselves in. So it's becoming difficult for everybody to complete their own end of the bargain. So the lenders are having to say, okay, we're going to extend the offers for another 3 months so that everybody will have enough time to do what they've got to do, and then we'll review it after that time. So that's the mortgage update based on the current market situation. Now let's dive straight into our topic for today. So our topic for today, as we have earlier introduced, is based on mortgage products and interest rate options. Now, mortgages, a lot of the mortgages, so excuse me, it's just a little bit too hot here. Turn this off. Thank you. So, mortgages are products that are based on interest rates. So when you borrow money from the bank to buy a house, the bank charges you interest on that. So a lot of the mortgage products carry interest rates. It is those interest rates, within those interest rates that the profits of the banks or the lenders lie. Okay, so no matter the mortgage product you have taken, you've got to pay interest on that. Now, there are different ways that these interest rates are applied. That is where the option lies. And that is where we're talking about, that's what we're talking about, interest rate options. You have to choose how these interest rates apply to you, apply to your mortgage product. The choice is yours to make. So when you go to take mortgage advice from a broker, you have to let the broker know what your preference is. As brokers, we ask the clients questions, and based on the answers we receive, we can now recommend the right mortgage products for them and the right kind of interest that they have chosen, that they want to apply to their mortgage application. And when we get those answers, we can now make the right recommendation for them based on their preferences and their choice of interest rates options. Okay, so we're going to be talking about some of these interest rate options available to you. And these interest rate options on their own are like mortgage products as well. Number one we're going to be talking about today is the standard variable rates interest product, standard variable rates interest product. It's normally shortened as SVR. Yeah. So what does the standard variable rate mean? First of all, the standard variable rates product used to be the most common mortgage product in the market until competition came in and innovation as well. A lot of lenders now started coming up with very creative and innovative mortgage products. The standard variable rate product used to be the most common mortgage product. What does this product entail? Standard variable rate products on mortgages simply, as the name suggests, means that the interest rates on these products vary with the general market condition. So it's a standard variable rate. So the interest rate is not steady. It varies with the general market condition. So if the general market condition warrants that the interest rate goes up, it will go up. If the general market condition warrants that the interest rate goes down, it goes down. It is at the lender's discretion, basically, to choose to either increase their standard variable rate or to reduce it, depending on the lender's perception and interpretation of the movements in the market. So what does this mean? If the interest rate goes up, it means your monthly mortgage payment is likely going to go up. If the lender reduces the standard variable rate, it means your monthly mortgage payment is also likely going to come down. Now, usually lenders have been criticized for being reluctant to reduce their interest rate on standard variable rate products, even when the market changes have occurred that warrants that they should be brought down. One of the biggest factors that affects standard variable rates products is the base rate. For example, in the UK here, the Bank of England is the central bank, the banker's bank. So the Bank of England decides what the base rate is. So when the Bank of England increases base rates, lenders have been criticized to quickly increase their standard variable rates of interest. But when the Bank of England reduces the base rates, the lenders have been slow in applying that same reduction to the borrowers. And that's the criticism that lenders have received over time, the speed with which they respond to these two extremes of market situation and rate changes. But the bottom line of it is that the standard variable rate product is a volatile product. During market volatility, your mortgage repayment, your monthly mortgage repayments are most likely going to be very, very unstable. So when the market is very volatile, for example, in the situation we find ourselves now, within the space of 1 week, the Bank of England reduced the interest rate from 0.75 to 0.25 and from 0.25 to 0.1. So that's volatility, purely defined. So, but the good thing is that the base rate has been on a downward, trend in terms of its movement. So the expectation then is that lenders would apply that reduction to the borrower's products. Those who are on standard variable rate products expect their interest rates to come down, and by extension, they expect their monthly mortgage repayment to also come down with that. So what has happened in the market is that some lenders have applied that reduction immediately to their standard variable rate products, while some lenders have not done so. They've kept their standard variable rate products the way it is, at the level it is. They have refused to apply that change. So that's why I said it is at the discretion of the lender to do this. They are not obliged to do it. It is at their discretion to whether to reduce the rates or not to reduce the interest rates. But do you know, people on standard variable rates, I don't know, not a lot of them understand the implication of the product, and what the product offers and what the product enables them to do and what the product does not enable them to do. But I'm going to make that clear to you now. I came across a client recently who has been on standard variable rate products for more than 10 years, basically. And then I asked her, why have you not bothered to remortgage? And to my surprise, there are still, clients, borrowers who don't even understand what a remortgage means. And she asked, what's that? What's remortgage? And I said, okay, remortgage is simply exploring or shopping around and getting your mortgage product onto another product, maybe by another lender or even the same lender but a different product, simply taking advantage of a better product out there and then changing your product, your mortgage product according to your preferences and your circumstances and your objectives. Remortgaging doesn't always mean your mortgage will be cheaper. You might remortgage onto something that means you will be paying a little bit higher, but it may also mean that you raise some more capital from your property, and then you are now having to pay more than you are going to pay. But product transfers are also a form of remortgaging. That means you are just taking advantage of a different kind of mortgage product without raising any extra capital on top of that. That's a topic for a different day. But what I'm saying is that if you're on standard variable rate product, you are not bound to be in that product. It simply means that you are free to go onto a cheaper mortgage product or onto a better mortgage product if you want to, without incurring any penalties or any charges. A lot of people who are on standard variable rate product do not know that this option is available to them. They think that because they've got this mortgage product, they are stuck, with that. Therefore, every time their mortgage keeps going up, they don't know what to do. They just say, oh, my mortgage payment is not stable. This month I'm paying 600, the next month is gone up to 625. In 3 months, 3 months ago I was paying, 675, and it keeps fluctuating. It keeps fluctuating because the lender is adjusting the interest rate according to the market changes. So if there's need for them to adjust, they'll just write you a letter and say, oh, we are going to be making adjustment to your interest rates. So from next month, your mortgage payment will increase from 625 to 650. You receive the letter, you do not know why it is happening. You don't even understand why the lender is doing it. It is simply because the product you are on enables the lender to adjust, to make those adjustments according to market changes. So you have an option of remortgaging onto a different product if you feel that there is room for you to make that adjustment. But you've got to take financial advice before you do that. If you cannot do it on your own, take financial advice. Talk to a broker and see if there is a product out there that is better than what you're already paying. But like this client I came across that doesn't even know what remortgage meant. That I looked at the product she was on, she was just practically throwing money away. And she was happily paying this money away to the lenders. And when I said to her, do you know you can remortgage this product onto something better? And you'll be paying a lot lower than you are paying at the moment. I could save practically hundreds of pounds. I said, I can reduce your mortgage payments drastically. You are paying far too much on your mortgage repayments every month. And she said, oh, I never even realized I could. I said, yes, you can. You can actually do that. So I'm working with that client at the moment to help her get, a better mortgage product and help her save a lot of money. Now, what the standard variable rate product does is that one of the disadvantages of it is it does not allow you make budgets for income and expenditures in the household. So your budget is not really very steady. If you're the type that wants to know exactly how much goes out from your account or how much you pay for household expenses like mortgage, and you want that to be steady and you want some certainty around it, standard variable rate product is not for you. But if you're the type that just wants a straightforward kind of mortgage product that's not, no complications, you do not need to monitor anything, you just want to know, I got the mortgage, I just pay whatever I've got to pay, then it's very straightforward. You get the mortgage every month, set up direct debit, you pay your mortgage by direct debit. But if you need some certainty and you want to actually focus on your budgeting and make sure that you know exactly how much you're paying within a specified period of time, then standard variable rate products may not be the right product for you, depending on your circumstance. And that's why you've got to go through that process with your mortgage advisor, and they will talk you through what options are available for you, depending on your circumstances. Okay, so that is a standard variable rate product. Now, the second interest rate option we're going to be looking at here is the tracker product. Now, the tracker product is a kind of variable rate mortgage product, but the difference here is that it tracks a particular interest rate benchmark. That's why it's called a tracker product. It tracks a particular interest rate benchmark. So there are two major interest rate benchmarks that the tracker product tracks: the base rates and the LIBOR rates. So there is therefore the base rate tracker and there's the LIBOR rate tracker. Now let's take this one at a time. Let's start with the base rate tracker. Now the base rate tracker mortgage product, what does it do? It tracks the Bank of England base rates. Yeah, I'm using the Bank of England because, I'm talking about the UK mortgage market and the UK mortgage environment, right? So I'll be using more of the UK market environment in my analysis and my explanation. So the base rate tracker tracks the Bank of England base rates. So it tracks it for a given period, typically for 5 years. Now, because it tracks it for that period of time, what it means is that the movement of the base rate determines what interest rate you pay. Yeah, there are some lenders that actually have lifetime tracker products that are not, time bound or time limited. But within the period, whatever period it is that your base rate, your base rate tracker product is, the fundamental underlying principle around this product is that it tracks the Bank of England base rates. So lenders set the base rate tracker products a percentage higher or lower than the base rate. Okay, so if the Bank of England, for example, now the base rates for the Bank of England is 0.1%. So if the lender have set the base rate at 2% higher than, base rate tracker product at 2% higher than the base rate, it means at this moment in time, your mortgage interest rate will be 2.1%. Now compare that to when the base rate was 0.75%. It means your mortgage product then was 2.75%, and when the Bank of England brought it down to 0.1%, your mortgage rate dropped from 2.75% to 2.1%. This is automatic. Yeah. So that is what the product states, that this product will be tracking the base rates. Whatever the base rate does is what the product does. So if the base rate drops, as long as we have our 2% margin, so that whatever is on top of it is the margin for the lender, because the base rate is the rate at which they borrow money from the Bank of England. So whatever they put on top of it becomes their markup. So if you are on a base rate tracker product, it means that this in this current circumstance, depending on what your lender or your mortgage provider has decided to put on top of the base rates, that is what your interest rate will become. That is what the base rate tracker product does. Now, the base rate is reviewed every month by the Bank of England, by the Monetary Policy Committee. They review the base rate every month. So it means that the base rate tracker product also is reviewed every month. So if nothing changes in this particular month, nothing will change in your base rate tracker product, as long as it is within that given time period that the base rate tracker product lasts. All right. So the interest rate change is usually significantly lower. For the base rate tracker product, the interest rate is usually significantly lower than the standard variable rate products of the banks. Okay, so if that's when the standard variable rate products, like we described earlier on, if the lender chooses to reduce the interest on the standard variable rate product, it may not affect the base rate tracker products if nothing has happened in terms of the base rates. So if for example the lender says we want to reduce our standard variable rate product from say 4.75 to 4.25%, it doesn't necessarily mean that your base rate tracker product will also reduce, because what happens is the base rate tracker product is usually significantly lower than the standard variable rate product. So the standard variable rate products are very well marked up by the lenders. So the markups or the margin on the base rate tracker products are usually lower than that of standard variable rate products. So the lenders can actually play around with standard variable rate product, and they could with the base rate tracker. So that's why the base rate tracker is specifically tracking the Bank of England base rate. So because the current base rate is 0.1%, whatever, so you have to check your mortgage product, check your mortgage deed, check with your mortgage lender, and see if you're on a base rate tracker, if you're on a tracker product, see what your current tracker product is. If the lender says it's going to be 1% above the base rate, it means your interest rate now should be 1.1%. But then the base rate tracker product sometimes could also be a percentage below the base rates. For example, in 2009, something happened. Yeah, during the financial crisis, the base rate dropped to 1%. And there were some base rate tracker products that were basically 1 or 2% below the base rates. So if that base rates tracker product was 2% below the base rates, it then means that the lenders would have been paying the borrowers instead of the borrowers paying the lender. So what the lenders quickly did then was that they adjusted their products to include minimum interest rate applicable. So there is a certain minimum below which that tracker product must not fall, so that at least they can still be in business. Because if they had applied that base rate tracker product the way it was stipulated, maybe 2% below the base rate, and the base rate dropped to 1% at that point in time, it means the interest rate on that mortgage would have been minus 1%. So the lender would have been paying the borrower instead of the borrower paying the lender. And a lot of borrowers would have said, that would have been nice, isn't it? You know? So now, because of that experience, a lot of lenders have now introduced minimum interest rate in their base rate tracker products. So no matter how low the base rate goes, they have introduced a minimum. So even if their base rate track, even if your base rate tracker product is a percentage above or percentage below, it cannot go below that set minimum. So at least there is a buffer now for the lenders, for them to at least fall back on if the base rate is very low, because at this point in time, the base rate is at rock bottom of 0.1%. So you can imagine if the lenders did not put a minimum and their base rate has been a certain percentage below the base rates, it would have been catastrophic for the lenders, wouldn't they? Okay, so that's what the lenders did and how they adjusted it from that 2009 up to now. That's the adjustment. Now, there are certain conditions attached to this base rate tracker products. First of all, there are arrangement fees that are applicable, and these arrangement fees are set by the lender and they vary from lender to lender. There is also possibly early repayment charges applicable to these products. Early repayment charges are basically charges that are applied to your mortgage product if you redeem that mortgage earlier than agreed, whether you are partially redeeming it or you are fully redeeming it. Say, for example, you have a tracker product that was set for 5 years, and then you choose to pay off, the mortgage earlier than 5 years, either partially or fully. The lender will charge you early repayment charge, because what you're doing is that you want to pay off what you owe them within that 5 years and then get yourself out of their shackles and then get onto another mortgage product. The lender have protected themselves to say, if you want to do that, we're going to charge you. But the early repayment charges basically apply to you if you intend to repay your mortgage earlier than agreed. Now, you might also be asked to compulsorily buy some associated products like buildings and contents insurance and mortgage payment protection, not necessarily from the lender or from the same mortgage provider. You can get it from any provider or from any supplier. But the lender might say, before we agree on this mortgage, you must please get your property insured, both the buildings and the contents. But the basic barest minimum is buildings insurance. They want the building insured. And they might also ask you to get a mortgage payment protection insurance, which means in the event of death, they want to be sure that the mortgage will be paid. And there will be no need for them to start chasing your loved ones around without the lender even telling you that. That is what you ideally should be doing. And that's what we advise all our clients to do when we arrange mortgages for them. Arrange an insurance policy that will take care of at least your mortgage payment or repayment if anything happens to you, even in the event of critical illness. We're going to be talking about, payment protection at some point, or other forms of protection at some point in the future. But just bear that in mind. Okay, so most arrangements on the base rate tracker allow the borrower to make overpayments, and it allows you to make some extra payments either in lump sum or gradually over a period of time. But then they set a limit within which you can make overpayments. So some lenders say you cannot overpay more than 10% of the outstanding mortgage value, in a year. So if the outstanding mortgage value is, say, £200,000, you cannot make overpayments of more than £20,000 in a particular year. If you do that, whatever is on top of it, the lenders are going to charge you. That's what they call the early repayment charge. So bear in mind that the base rate tracker product, some of them might carry an early repayment charge. So bear that in mind as well. Now let's talk about the LIBOR tracker. The LIBOR tracker, LIBOR is basically, it means London Interbank Offered Rate. Now, the LIBOR tracker is a kind of tracker product that mostly they are used by subprime lenders or commercial mortgage lenders. LIBOR is the rate between, the rate at which banks lend money to themselves. So it's called a London Interbank Offered Rate, usually set between 0.1 to 0.2% above the Bank of England base rate. So if the banks lend money to themselves at that rate, some subprime lenders do raise money from the banks as well, and then they add that they add their margin on top of that LIBOR rate. So you can see some of your mortgage product, it could have been at LIBOR rate. You say LIBOR plus 1% or 2%, or LIBOR plus 2.5%. It means 2.5% on top of the LIBOR rate. So that's a LIBOR tracker mortgage. So the LIBOR tracker mortgage, like I said, it's mainly used by subprime lenders. Subprime lenders are lenders who specialize in lending to people with impaired credit or credit issues, people with credit history issues, people that their credit ratings or their credit scores are not perfect. There are specialist lenders, and some of these lenders normally use LIBOR rates. Not all of them, some of them do. And some lenders who do commercial mortgages, some commercial mortgage products are done on LIBOR. So LIBOR tracker is not very common among residential mortgage providers, but you can find it mostly among subprime lenders and commercial mortgages. Okay, folks, so I will leave it at that today, and then we are going to carry on with the remaining parts of the interest rate products from next week. So bear in mind that we are educating you on the options that are available to you, so that when you are making a choice of interest rate products that you want to choose when you do your mortgage, you can know exactly what suits your circumstance. But hang in there. We're going to be back next week, and we're going to bring you more on other interest rate products that are available to you in the mortgage and the marketplace. Thank you so much for being part of today's episode, and God bless you. Please stay safe, and please be wise. Stay at home if you can, and stay safe and save lives. God bless you all, and I'll see you again next week. Take care. Bye-bye.